Many economists view a recession as a necessary part of the cycle, a period where bad debt is cleared out and prices are allowed to settle back to sustainable levels. But in the United States, that natural reset has effectively been banned. The Federal Reserve and the government have reached a point where they can no longer allow the economy to contract on its own. The math simply won't allow it. With $39 trillion in total debt, the U.S. economy now functions like a massive house of cards. Even a minor tremor in GDP risks a total collapse of the national credit system. A modern recession would trigger a chain reaction that hits the government, the bond markets, and personal savings accounts simultaneously. Navigating this environment requires looking past the surface-level headlines and understanding exactly how tax collections, national debt, and interest rates have become an inseparable feedback loop. The first domino falls when the economy slows. As businesses earn less and people lose their jobs, the stock market typically follows, wiping out trillions in paper wealth. Because the government runs on income, corporate, and capital gains taxes, this broad decline causes tax collections to drop off a cliff. Historical data shows how quickly the budget breaks. Following the tech bubble burst and the shock of September 11th, total federal tax collections fell by 10% in just 3 years, turning a budget surplus into a massive deficit. This chart shows the aftermath of the 2008 Great Recession. As the stock market crashed, tax collections plummeted by 18%, causing the deficit to surge from $160 billion to over $1.4 trillion. Recessions hit the federal budget from both sides. While the government's revenue is disappearing, its mandatory spending, things like unemployment benefits and social safety nets, must rise to keep the economy from bottoming out. We saw the extreme version of this in 2020. To prevent a total shutdown of the markets, the government launched unprecedented stimulus programs exactly when the tax base was at its weakest. The result was an explosion in the deficit, which jumped from roughly $980 billion in 2019 to over $3 trillion in a single year. These events prove that a recession is a two-sided attack on the federal balance sheet, starving the government of cash at the exact moment it's forced to spend the most. The debt-to-GDP ratio is a key indicator of national financial health, currently sitting at a baseline of 122. The government relies on investor confidence to fund these deficits by selling treasury bonds. Investors buy these IOUs based on the belief that the system will remain stable and the debt will be managed responsibly. If a surging debt-to-GDP ratio causes that confidence to waver, investors begin to demand higher interest rates to compensate for the increased risk of lending to the government. Here is the mathematical reality. The U.S. is already paying $1 trillion a year just in interest on its debt. Forcing higher rates onto a $39 trillion load would consume an unsustainable portion of all tax revenue. This feedback loop suggests that a standard recession could quickly escalate into a crisis the Treasury cannot manage, which is why a downturn is no longer viewed as an option. The Federal Reserve faces a binary choice: allow the country to slide into a deep economic depression or administer a highly potent financial medicine. That medicine is the creation of trillions of dollars out of thin air. By printing money to buy its own bonds and fund the deficit, the government can artificially stall a contraction. Because politicians operate on short-term election cycles, they're incentivized to choose this path every time, effectively kicking the problem down the road for the next administration to handle. The unavoidable consequence of this constant intervention is persistent inflation. The more money is created to prop up the system, the less each individual dollar is actually worth. If you hold your savings in cash based on the assumption that the economy still follows traditional cycles, you are likely to see your purchasing power steadily erode. To preserve wealth in an era of guaranteed intervention, many are moving away from paper currency and into physical assets that can maintain their value as the dollar continues to be devalued.